this webinar hosted by FX Street. Thanks FX Street for inviting me once again. We like doing these. We've been doing these for a long time, actually many years. I think we started back in maybe around 2015 or something. So we've been doing for a very long time. They're always a lot of fun. But today we're going to talk about something that occupies me a lot. Let me bring out the chat box so I can see everyone's questions if there are any. Good. Yeah, this occupies me a lot because I mean the act of trading is a lot of fun, but trading in itself is not terribly exciting. It's not that you can't compare it to going to Tivoli or anything like that. It's just you put some orders in the market, they get filled, they hit their targets, or they get stopped out. It's pretty boring, actually. It's quite mundane, and I think that's the way it should be. Because if you're looking to trading for entertainment, well, I think then that's when risk is increased. And so the way I introduce entertainment into my trading life is programming software that is related to trading. And I mean, the topic of today's presentation is asset strength reversion, algorithm trading. And so this is something I spend a lot of time on, algo trading, and I love it. Does anyone here in the room also occupy themselves with trading robots and stuff like that? Just give me a yes or no in the field. It'd be interesting just to hear if there are any other. Sometimes. Oh, cool, Pete. Hey, Pete. That's cool. It's a lot of fun. It's a very, very fascinating thing to do, I think. So today we're going to talk about a few things. Here's the agenda. What is asset strength? Quantifying asset strength, a model, proof of concept, some results, final words, and some questions. It's a pretty short presentation, and I'm hoping that we can maybe have some questions towards the end that we can spend some time on discussing. Okay, so I mean, what is asset strength? Well, if you look at the price of an asset, there are only really two people involved in the market. You have people who are buying and you have people who are selling. Then you have people who are have an intention to either buy and sell, and that intention is put into the marketplace in the form of a pending order. This can be a buy limit or a sell limit or a buy or sell stop, whatever. But this is showing some kind of an intent. And so this is why I'm always focusing on the concept of supply and demand, or as I call it, liquidity distribution. And for some of you, for those of you who aren't familiar with these concepts, you can check out the other webinars that I've done, and I go into great detail in relation to supply and demand and buy and sell zones. And it's a very, very fascinating topic. And what else can you use? You can use supply and demand. What else? Well, you can use the amount of the asset that's being bought and sold, so the volume of it. You can also use something called momentum, which is essentially showing us how quickly an asset is being bought or sold. And while you can look at a price chart and you can say, wow, this is really being bought because price is going high, you don't really know how much is being bought or how quickly it's being bought. And so you need a way to quantify what's going on. Okay, and then we have trends, and these are typically like the macro trends. So maybe a look into the fundamentals, interest rate differentials. These days it's pretty easy because nobody's giving any carry for anything. And so you have to be able to take the information available here, and you have to plug it into some kind of a model, and hopefully it spits some output back to the user, and this user can use the output to make trading decisions. Okay. Then we have quantifying asset strength, and so what I'm doing is I've created a pretty simple quantitative model that reads data from my trading platform, and it performs a lot of analysis on the data that I'm receiving. Okay, and as a result of that analysis, I know what I'm looking for, and then I'll wait to see if the software is telling me we have some kind of a development happening on Bitcoin US dollar or cotton or orange juice or the euro American dollar. And this is the stuff that becomes important, because you can have a ton of data, but maybe there's nothing in that data that would lead one to believe that it would be a good idea to either buy or to sell it. And so what I like to do is I like to take the data, and I like to put the data in some kind of a graphical representation so that I can look at it. And this I mean, in relation to algo trading, this is called like data first. Normally you have data first or you have idea first. And data first means that you're looking at the data, and based on your observations, you're building some kind of a framework about that data and future expectations to that data, and building a trading model on top of that. In contrast to idea first, where you have an idea, you have a hypothesis about something in the market. It could be, for example, that if we have a rally during the Asian session, that rally or that gap normally fills during the London session. That could also be a valid hypothesis that we could then try and analyze. These, I mean, they're equally good. They're just two different approaches, two ways to skin a cat, essentially. And so visualizing data is something that I really like to do. If I just give you a quick example of that, I mean, this is the data that I want to visualize. Let me turn this off. So we have a bunch of lines. It doesn't really matter what they do, but they're telling me essentially where we have an interest to buy and to sell. And so this is something that enables me to make that decision. Okay, so I can look at this information. I can go back historically. I can have a study. I can see if I can find some patterns, either by doing it manually or doing an automated analysis, and then I will build my trading model on this data. But the data that goes into this is coming from all of the symbols that you can see here on the left side of the chart. So all of this information is being downloaded, is being fed into an algorithm, and it's spitting it out in the form of this graphical representation. And this to me makes sense. And so this is what I'm trying to build a model on top of. Actually, you couldn't see that, could you? Let me see if I can share application, a trading platform. Okay, here. So this is the data that I was referring to. Okay, can you see my trading platform now? I don't think it was visible before when I was blabbering. Yes, cool. So what we have here, I mean, this is the result of my algorithms analysis. It reads all of the information on the left side of the window here. It's fed into a quantitative model. The analysis is performed, and it's displayed like this for this asset, which is the pound Canadian dollar. We can go to, for example, we can go to the euro Singaporean dollar, and the analysis continues. I mean, here it's going to perform it's going to spin quickly. Now it's crunching numbers, and then in about 2 seconds, it'll display the result of the analysis. Boom, there it is. And so now I can see a similar information, and the information that I can see here is relative to the euro Singaporean dollar. Okay, good. Okay, so now I can go back to my slides. Good, here we are. And so, yeah, so I look at the visual representation of that, and I'm making my decisions, or I'm building my trading rules based on the data that I can see here. Okay, so if we look at a model, my model is essentially based on cycles, but the trading model can be based on something as trivial as moving averages or some other secondary representation of price, so some kind of a technical indicator. It can be based on arbitrage. It can be used on interest rate differentials, or it could have been in the old days, you know, when you had, for example, the Australian dollar, Japanese yen carry trade. It can be based on many, many things. But I like cycles because this makes sense to me. We have periods of expansion, and then we have periods of contraction. And these normally happen between 3 and 5 times. So we have a period of expansion, contraction. That's the first one. Then we have another one, expansion, contraction, another one, expansion, contraction. And that can happen 3 to 5 times. Okay, and so my model focuses on this. And I suppose if you want to compare cycles to something else, I suppose you could compare it to something like Elliott waves, where you have the first wave, wave 1, A, 2, B, you know, or you have the first wave, then you have the pullback, the ABC, the second wave, the ABC. It's kind of similar to that, but it's not looking at a price chart. It's looking at the results of an analysis of the data, which to me is a little bit more of an edge, because at least for me, Elliott wave is a little bit too subjective. And so the question becomes, well, which low do I start the analysis on? Is it this one or this one? And so unless everybody has the same starting point, the results will vary. And so by quantifying the data in a different way, like I'm doing, for example, it just makes it a little bit more objective. And objectivity is something that you need, especially if you're trying to program a trading robot. And so the process is, I mean, you define your criteria. I have a criteria based on cycles of an asset, expansion, contraction, as I spoke about. And then we have to gather the data. And so this can be as simple as downloading moving average data or some other technical indicator data. It can be maybe in relation to what I'm doing is I'm downloading all of the data for all of the currency pairs, and it's all going into a model, and then it's being analyzed, and it's giving me information that's telling me how strong the euro is, how strong the Swiss franc is, the Singapore dollar, the New Zealand dollar, and so on and so forth. And so I'm getting a lot of information and I'm analyzing it. And so the data gathering is actually quite important, but more important is the data cleaning, because as the data science expression goes, garbage in, garbage out. And so you have to take the data and you have to scrub it in some way. And you can either remove data that's not correct. And this data could be, for example, we could have some, for example, extreme outliers. So if we have a group of data that more or less resembles, where each data point resembles the other, more or less. So if you had to put like a best fit, a trend line on the data, it would fit quite nicely. But sometimes you're going to have these huge outliers where, let's say we have an average of the most of the data, which is, let's say, the number 5, but then you have outlier data, which is 217 or minus 412. Okay, this information is not useful because number one, it's a rarity, and number two, if you're looking at averaging, it's going to distort the average to a very, very high degree. And so we can either remove those or you can normalize them. So you take the data that looks a little bit weird, you run it through an algorithm, or you can massage it in some way and to make it look like the rest of the data without losing its value. And then you analyze the data, which will give you some kind of a result. And then this result is kind of the gold, I think, where you have your data, you put it in, you analyze it, you clean it, you analyze it, and then the result is kind of the result of the hard work. It's kind of like you have a miner who goes into the river and he's sieving. That's all the hard work, and the data, the extracted data, is like the little nuggets of gold that's in the pen. So this is very, very important. And so when you have this data that contains all of the information that's relevant, well, then you have to, in some way, analyze this data once more and use that to tell you if you should be either buying or selling the asset that this data pertains to. And it's very important to it's very important not to overfit as well. And I think I talk about that in just here, where we have, I mean, for my methodology, my model, I've made an algo trader, and it's really good when you have an algo trader and you start to backtest. If you backtest, you'll be blind to the fact that your algo trader or your algorithm or your model, whatever it is, can also lose trades. And this is because we have a bit of a confirmation bias when we're looking at data, and that is our subconscious mind brings to our conscious mind's attention data that fits our preference or our bias. And this is really, really dangerous when you're looking at data that is as neutral as, for example, asset prices. And so we have to be really, really careful that you're not trying to overfit. And backtesting does that. This is why I never do any backtesting. And so what I'm doing is I'm taking the data, and it is, sorry, my wife is rabbiting in the other room. So we have the data, I have my hypothesis, and then I like to put it to work immediately on the market, so only forward testing. And something that's really important, I think, with forward testing is that maybe, as you'll see in just a moment when I show you the results of my trader is that we have a period of some kind of a market state, and the market is doing one specific thing. And while the market is in this state, the algo is earning tons of money or it's losing tons of money. You don't know which one because you don't know what state the market is going to be in. But during that period, one might be led to believe that the algo is super profitable, or the algo is rubbish because it's not earning any money. It's losing every single trade. And so drawing conclusions on a sample size that is non-substantial or not big enough is a really, really bad idea, because maybe you're sitting on a golden egg and you put it to work for a week or 3 days or 4 weeks, and you have a sample size of, let's say, 150 trades. Well, then this is not going to be a very good sample size that you can use to draw any conclusion whatsoever. And so I like to put it in and have 10,000 trades, because I know after 10,000 trades that we've experienced many periods of expansion and contraction on many different asset classes. We've experienced some kind of a flash crash. We've experienced holidays. We've experienced weekend gaps of all sorts, shapes, and sizes. We've experienced pretty much everything that you can experience. Okay, and so it's super important that you expose your algorithm to flash crashes like we experienced several times in the past. And so you want to be able to see how your algo can perform in a situation where the bottom has fallen out and everything is plummeting. Okay, and this is really important because, I mean, my algo, this one at least, it's a mean reversion, and price is not always going to revert to the mean. And so when it isn't, when it continues to go, I want the algo to be aware of the fact that it's losing money, and I want it to shut down very, very quickly. Because during the times that we are reverting to the mean, it's going to earn a decent money, but the times that it's not, I want it to stop, because all those profits will be given back. And so you want to slow down the hemorrhaging or switch it off. You want it to switch off until the market settles down, until the market state represents the data that the robot will be able to be profitable on. Okay, so we have using the model, you create an auto trader, and this can be done in many different platforms. I'm currently using MetaTrader, but I've also done similar things in Python frameworks. I mean, there are a plethora of different options that you can use in order to automate a lot of your trading strategies. There are also, if you're not a programmer and but you have an idea, so you have your idea first, you can take this and you can use something like, I think it's FX Pro in the UK, and they have a visual expert advisor builder where you have your hypothesis, you create a rule set. So you take your idea, you implement it using this graphical builder, which it's quite clever actually. There are many of them, but this is just one example that I recently saw. And you use it simply by dragging boxes onto this this canvas. So you have the canvas, and let's say you have you're looking for open prices, specific open prices, or specific behaviors of open prices. Well, then you can drag a box on there and you can define the behavior, the criteria, and the expected results. And you can build it this way, and it's really nice, and it's very quick, so you're not forced to write code. And even if you are a programmer, programming can take time because you have to write it, you have to debug it, you have to test it. And so there, I mean, I have, you know, my SVN, my software development server, I have production, I have development, and then I have an experimental build. And all my kind of Einstein stuff, Einstein as in crazy, you know, like all these really quirky ideas that I'd like to try, I write into the experimental build. The stuff that I see promising, I move to the development version, and when it's been tested and is running well, then I move it to production, then it's released. Okay, so it's really important that you have a way that you can do these things. Okay, Pete's asking, what was the name of that platform? I think, you know, let me have a quick look. I think that it's FX Pro in the UK, Pete, and they have a visual builder. but there are many others. There's also, what are they called? There was one out of Copenhagen, Denmark, called Magic, MAGIK, I think it was spelled, but they recently changed the name, or a couple of years ago, to something else. But there are loads and loads. If you search for, yes, FX Pro, if you search for graphical expert advisor builder, you will get a big selection of possibilities. Okay, so you create the algo trader and then you let it run. Hey, my pleasure, my pleasure. And then you let it run. And this is the best part, because you have your idea. It went from conceptualization to a kind of a concrete kind of idea, and then it was implemented maybe on paper or on a whiteboard or something, and then it was translated into actual instructions. And then now is the day where you say, okay, start trading. And it's very exciting. It's really, really exciting when this happens, because then you're actually seeing your algo trader live and breathe, buy and sell, and open trades and close trades. And it's a really exciting time. Okay, and so when you have that, then it's a matter of letting it run on, let's say, 10,000 trades or many, many trades. Essentially, you want it to run over a period of 3 to 6 months. And normally after 3 to 6 months, depending on what kind of an algorithm you're running, you'll get a high number of trades in the tens of the thousands, and this is good. So if I just show you very quickly what I have so far, and this is after, how long is this? I opened it maybe 2 weeks ago. The algo started to run. I'm just going to show you what it looks like so far. And so we started off with $10,000. We currently have a net profit of 3,100. So we have 31% in 2 weeks, which is absolutely remarkable. But this, it sounds really amazing, but this is the important bit. This was when I switched it. I switched it on here, and it went up to 50% profit, and it had floating 10% in profit. So up to $16,000 after the first couple of days. And I left it. I didn't touch it. It's a fully automated trading robot. I don't want to meddle and ruin the data, taint the data. So I left it. And then that floating P&L, they all lost. And then we won some and we lost some. We won more and we lost more, and we won and we lost, and you can see how it goes. And this is just the beginning. And so we're waiting. I'm waiting now for these numbers of trades to tick in. And so far we have 250 trades, which it sounds like a lot, but it's not a lot. It's not a lot. It's not enough data to draw any conclusions whatsoever. So we're still waiting, and it's still running, and we'll see how it goes. I have updates that I'm constantly introducing. One of the updates that I'm working on right now is the concept of a trend. And so how do you quantify a trend? Are you looking at a technical indicator? Are you looking at market structure? Are you looking at moving averages? Are you looking at trend lines? There are so many ways to quantify a trend. And I've looked at about 120 different ways, or I've tried 120 different ways to quantify a trend, and it hasn't been successful. But what I've done recently is I've found a way using the data that is essentially the output of the algo. Can you guys see this again? The histogram. Super. And so what I'm looking at now is I want to use this data to help me. Hey, Carlos. Oh, cool. I didn't see you in there. Nice to see you. So I'm looking at this now to try and use this to help me assess if there's a trend or not. And some of it is manual work, and some of the other tests that I can do, I can automate. But it's it's a long. Normally, it's a very, very long process. And if you think of like a big investment bank who has a team of 50 developers and 5 physicists and 10 quants and X number of economists, I mean, development goes so quick. But if you're a guy like me, and it's just me and my 2 cats and my 2 boys and my wife, it's really slow. But the good thing, what I'm doing to help me test it is I'm letting it run on many different VPNs, and I'm getting it to run on different time frames, so I can find maybe a bias that's telling me, okay, the smaller time frames are more profitable, or the medium term or the long term time frames are profitable, currency strength are profitable, or commodities. So it's trading almost everything on every time frame at the moment. Then after my 10, 20, 30,000 trades, then I'll be able to draw some conclusions. And so far, the conclusions are that the 4-hour chart is a very good pair to trade, and euro crosses and pound crosses are the most profitable. So the pound, so these ones here that you can see here, the American dollar CAD, that doesn't show any significance whatsoever of being a profitable instrument, but you can see these patterns begin to emerge after 1,000, 2,000, 3,000 trades. Then you have to follow these, and you can see because the profits for certain symbols start to diverge from the rest. And this is beautiful, because this is, wow, we have our first pattern emerging. And this is fascinating. So far, the 4-hour chart, euro pairs and pound pairs, this is what this algorithm works the best on. And so I haven't changed anything yet because it's still too early. But what I am doing is I'm making a mental note of the fact that this is the case, and I will revisit these when I'm done with this simulation, and I will only allow it to trade euro and pound crosses on the 4-hour chart. So very exciting, I think, very exciting indeed. And just to give you an idea of what it would look like. So look, there's a lot of stuff in here that doesn't really matter, but something that's important is, as I mentioned, is loss mitigation. This is super important. So each day I will allow the robot to give back 2%. If it exceeds 2%, then it switches off for that day. Okay, and I'm not going to allow any more than 2.5 losing days a week. So if I lose 5% or more, then the robot will switch off for that week. And for the month, it goes to 10%. So this is my way to help the robot stop losing money, because I know that during ideal market conditions, it's earning tons of money. Hey, Albert, good to see you in here. It's earning tons of money when the market conditions are perfect. But when are they perfect? They're perfect maybe 1 out of 10 times. And so I want to ensure that when market conditions are perfect, it's raking it in. And for the 9 out of the 10 times where it's not perfect, I want to make sure that I'm reducing risk where possible, and I am limiting how much money the robot is allowed to lose per day, per week, per month. And so I'm doing things like trailing stops. That is showing to be, okay, Albert, no worries. It's showing to be a good idea, because a lot of the times, according to this model at least, is, let's say we bought here, often price gets really close to the target, and then it comes down, then it gets stopped out down here. And I think, well, why on earth would I allow a trade to go so far towards its target and then allow it to be a loser? This doesn't make any sense whatsoever. And so enabling trailing stops and enabling trade management enables me to prevent this from happening. Rather, not prevent it from happening, because you can't prevent anything from happening really, but you can reduce the likelihood of it happening. And so this one here, the enabled trend management, is essentially, if it's buying here, it has a signal to buy here. It's looking for the opposite signal on the opposite side of the market to get it out of the trade. And so my risk is the same, my stop is the same, but my target is not put into the market, or it's maybe 50 times the size of the stop, and then I let it continue to go so the trade can continue to move towards its target. And this seems to be a really good way to do it. And this is because of historical analysis of some of the trades that I've done in the past, and that is that a lot of the trades, there's a really cool tool that a friend of mine introduced me to, called TraderVue, TraderVue. And the cool thing about this tool is that it enables, it shows a metric which I think is which is great, and it was something like potential profit realized, and it can be 100% or it can be 60%. And if it's 100%, it means that your algo got out of the trade at the point when it turned around and went back. And if it's 60%, it means that price moved, hit my target, but then went on to an additional 40% before it turned around and came back. And so ideally, I'd like to get that extra 40%. Why not? Okay, and so this trade is enabling me and a friend to analyze them and to help spot these patterns that are very interesting. Okay, Carlos is asking, what do you mean by the quantitative or quantifying a trend? Are you trying to define a type of a trend? Yeah, so, I mean, Carlos, if you look at, if we just look at this for a second, let me move these down. So if we look at this, I mean, you can see that, I mean, here was a downtrend, here was an uptrend. So I don't know if we're in a downtrend or an uptrend. On the daily chart, it just looks like that we're ranging between something up here and something down here. And so I don't really know, but what I do know is that if we're going down, I want to be selling, and if we're going up, I want to be buying. This is nice information to have. And while it's quite difficult and it's not that simple to do, it will certainly stop the robot from getting into trades that are simply not profitable. And I'll show you a couple of examples of ones from that it's taken. If we grab, let's look these two here. Okay, so if we look at this, I mean, the robot, actually, what time frame is that on? That was on the 4 hour. So you go to the 4 hour chart, look at 4 hour data. The robot thought that it would be a really good idea to sell here. But if you look at that, does that look like a downtrend? It doesn't really, does it? It doesn't look like a downtrend at all. And so preventing it from getting into this trade might have been a good idea. And currently, just looking at the new trend filter that I'm working on, let me let the histogram data load. I'm guessing just by looking at this that, yeah, it wouldn't have gotten into this trade. This trade would have been, would not have been taken with this new filter that I'm working on. And so, I mean, obviously this is going to prevent the robot from taking other trades that would have been profitable, where you have small pullbacks and an uptrend. I would have got in at the top and then out at the bottom before the trend continues. Obviously, I'm not going to get those trades, but they are the higher risk trades, and I don't really want to be in those trades. I would rather sit on the sidelines and wait for like a major uptrend, so like a gradual push higher on the daily, and looking for 4 hour pullbacks to demand before we continue higher. This suits me a little bit better, and it does support the hypothesis that a trend filter will be beneficial. Okay, so if we go back and have a look at these once more, some of the interesting metrics I think that are quite important to focus on, they are average profit trade. So the average profit trade is $39.56. Average loss trade is $36.63. This is a really good metric. What you don't want is average profit trade $10, average loss trade $60. You don't want that at all. You want your, over time, you want your winners to be bigger than your losers, because this is when you'll be profitable. Another thing that's interesting is average consecutive wins versus losses. And we have here 15 wins, and we have 9 consecutive losses. This is also an interesting metric. And this is another one too. Total short positions won, we have 69%. That's really good. Long positions won, 48%. That's less good. Okay, and here we have profit trades. We have 64% of the trades are in profit, and we have 35% of the trades were losers. And if you take this information, the profit trade potential to the average trade winner, I mean, if you consider these two here, I mean, overall, this is going to be a profitable robot. Okay, so these are some of the things that I'm looking at when I'm assessing the success of a given robot. Okay, well, that brings us to time for some questions if you guys have any. It's still pretty early days, but it's very, very exciting project. And I have several different algos running in an attempt to identify a combination of, for example, a mean reversion, a trend algorithm. Those two together are very, very interesting to me, because when one robot is losing money, hopefully the other robot is earning money to help cancel out or neutralize the losses. So this is something that you need to do in like an investment portfolio. You want some of the algos to work in conditions A and the other one to work in conditions B, so they can complement each other. Cool. All right. Does anyone have any questions about this stuff? And you ask me anything, and I'll answer. Which one is from my site? Actually, the Algo is it's currently, I have about 30 users using it, and they're using it for free. It's, I mean, people, yeah, the guys who are in my community, they use it for free, and they give me in return feedback. And this feedback is useful because it enables me to assess user experience. There are also some people that are trading on a bunch of different brokers, and this enables me to bring in much more information and feedback that I can massage into the algorithm and make it over time a better trading solution. Yeah, so we have, I mean, this one here, this one just here, this is just like the histogram, which is a visual representation of the price. And the algo is essentially, which is up here. This is the one that has the same core as this, and it's making trading decisions based on this. Yeah, is anyone here doing anything like this? I'd love to hear any of your experience. Carlos, what about you? Are you meddling at all with algo trading? Oh, did you? Cool, Pete. That's excellent. It's a really good place in there. There are some really nice people. We have quite a lot of people in there. We have there's some really cool institutional guys in there, and retired institutional guys and prop trading guys, and it's pretty cool. Okay, Carlos is saying perhaps connecting the last two peaks or valleys using a trend line spot to define a trend, but to connect them, attempting to interpret the potential future behavior. This is a very good idea, and this is something that I have been working on. Let me finish reading your question before I continue. That will require additional metrics like level of volatility or lack thereof, price behavior within a structural context. It's true. It's true. This is actually a really good way to assess a trend, because trend lines are too after the fact. And so what you want is something that I think is very useful, is indeed trend lines. So if you consider, yeah, there it is. So I've built that into this, and so here you can see we have a low, we have a high, we have a higher low, and we have a higher high. So this qualifies this low and this low as being a valid trend line. So according to the 4-hour chart, we're in an uptrend, and it's good. But it's also important that this is done correctly, because while we can have, let me see if I can. Let me turn off this stuff. Trend line management. Let me turn this off so I can draw trend line. So if we have, for example, we have a trend line. We have a trend line here. We don't want it as a ray. So if we have a trend line like this, so we have a low, a high, a low, a high, low, but the price after the last low has not moved above this one. Well, that can be very dangerous as well, because it could be price that's come from below and moving sideways in a pennant, looking to move higher, or it could be coming down from the top, moving sideways, continuing below. It could be a continuation pattern. And so it's important that you actually wait for the high to be taken out, like it has been done here. And ideally, I like a close price to happen above it. I want a candle to close above this high. This to me shows commitment, and we don't really have that here, or do we? Yeah, we do. We do have some closes above this high here, so that would be interesting. But you can see here, now that we had the low, the high, the higher low, the higher high, and now price kind of gapped down Monday morning, and it opened, and now we're slowly looking to move lower. So this will help keep you out of trades where price is in a continuation pattern. Okay, perhaps what we are trying to define is not the trend of the chart, but the most recent behavior within a contextual trending environment. Exactly, not easy at all. It really isn't easy at all. And so what I'm doing, my hypothesis is that if I'm trading on the 4-hour chart, I want to be looking on the daily and or the weekly and looking for a trend. So let's say that, okay, let's go to the 1-hour chart just to find a trade that the robot may or may not have taken. And then we can see what that would have looked like within the context of a trending environment on the larger time frames. Okay, so the robot would have traded right here. The robot would have opened the trade just here. But we don't know if we're going up or if we're going down on a greater time frame within the greater context. So if we go up to the 4-hour chart, we can see would this have been a good trade? So we can see here, looking at the same information from a different time frame, we can see that, well, yes, we are. But here's something else. We have a serious case of asset strength divergence where we have prices are moving higher, but the strength of the euro relative to the Swiss franc does not support a continuation of price moving higher. And so this is also something else that could lead one to believe that this will not continue forever. But if you look at this, for example, I mean, price is continuing higher, but actually this would not have gotten into the trade because we have histogram prices here, which is currently where this is, they are declining. So the filter would have kept this robot out of this trade. It would have been in profit, maybe we would have got to the target, but the trend filter would have stopped it from trading here. But you're right, it's so difficult, and I've looked at a plethora of technical indicators in an attempt to find something that works, and nothing really works that well. I'm trying to build study sets that measure different periods of the VIX contextually. I believe it could be an effective enhancer. The CME offers the VIX charts for different markets. Very cool. Very, very cool. Yeah, because VIX is an important metric as well. Volatility is incredibly important. As we're seeing in the crypto space at the moment. I mean, Bitcoin over $60,000. I mean, that's completely madness. And we're seeing a lot of the flows changing because of this hyperinflation that's upon us. And the VIX is a really good indicator to help us identify things like that. Without really knowing the underlying reason, we can see that something is indeed happening. That's very cool. Good. Does anyone have any more questions or any more comments? Otherwise, I think we can wrap it up for the day. Hey, such a pleasure, Vahid. Thank you so much for being here. Cool, Carlos. Thanks for being here. Thanks very much for being here. Hey, such a pleasure. It's an absolute pleasure. Hey, Pete. You're very welcome. You guys are welcome to jump into the Discord channel if you want. It'd be really cool to have you in it. We have a lot of really nice people there, and if you guys want, let me find the link. It's on the. If you guys go to the, let me type it in here. Go to the Pipnotic.com website, and just there on the top, there's a button that says join Discord channel. You just click on that, and then you can jump in there. And we have a couple hundred guys in there, and they're all really nice people, and so we have a lot of really interesting information there. Cool, Carlos. Well, I look forward to seeing you all in there, and I thank you all so much for coming here today. And if you guys want, if there's something specific you want me to cover during another webinar, or you have any questions, shoot me an email. I'm just going to put my email here, shah@pipnotic.com. Boom, there. You can shoot me an email, and if there's like, Sri, I'd like you to talk about this or that, and if I know something about it, then I'll be thrilled to to touch on it. That would be a great pleasure. Right, Adinda, I think we're good to go for today, unless anyone else has more questions. Cool. We'll wrap it up. But thanks everyone for being here today. Thank you so much, FX Street, for having me. It's always a pleasure. And yeah, guys, jump into the Discord channel, and we can continue our conversation in there. And thank you, Adinda, once again for helping out with these webinars. Thanks, everybody. Have a lovely day, no matter where you are. I'm in Mallorca, and the sun is shining, so we're quite pleased about that. It's nice to see the seasons changing and the flowers blossoming everywhere. It's lovely. All right, take care. Until next time.